This is why the state you live in matters more than you think. Where you retire can change your after-tax income more than your investment returns. When people think about retirement taxes, they usually focus on federal brackets, Roth conversions, Social Security taxation, and required minimum distributions. But there's another variable that can quietly reshape your retirement math: the state you live in. State-by-state tax differences can mean the difference between keeping thousands more per year or losing it unnecessarily, and the gap isn't small. In some cases, two retirees with identical portfolios and identical federal taxes can have dramatically different outcomes simply because they live in a different state. Today, we're breaking down how state taxes affect retirees, why headlines about tax-free states can be misleading, and how to think strategically about location when planning in retirement. Before we dive into all that, my name's Ryan Knoll, and I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm helping clients nationwide make smart money decisions. Let's get started. Why state taxes matter more in retirement. During your working years, state income tax is just another line item on your paycheck. In retirement, it becomes very strategic. Why? Because you now control where income comes from, when income is recognized, and sometimes where you live. And since retirement income often comes from withdrawals rather than wages, state tax treatment of different income sources matters enormously. The key question isn't, does this state have income tax? It's, how does this state tax retirement income? The big myth is there's no income tax, and that equals a free tax-free retirement. States like Florida, Texas, Tennessee, Nevada, and others get labeled as retirement friendly because they have no state income tax. And that's partially true. No state income tax means there's no tax on IRA withdrawals, no tax on pensions, no tax on Social Security, and no tax on capital gains. But that doesn't automatically make a state cheaper. Why is that? Because states without income tax often rely more heavily on things like property taxes, sales taxes, insurance costs, and estate or inheritance taxes in some cases. You're trading one tax structure for a completely different one. For retirees who plan to draw heavily from retirement accounts, no income tax states can be highly attractive. But for retirees with low taxable income and high property values, the savings may not be as large as advertised. What is even more confusing, though, is that there are states that charge no income tax while you are working and also don't tax IRA withdrawals. States like Texas, Florida, and Washington come to mind here. Then there are states that tax earned income, but not retirement withdrawals, such as Illinois and my home state of Pennsylvania. Next are states that tax every source of earned income no matter what they are. Places like California, Arizona, and Indiana are good examples of that. And finally, there's states that exclude a certain amount of income before taxing the rest. This is common in the Carolinas and in New York. So it's not a question of is it taxed or not, it's more a question of is it taxed, and if it is taxed, what are the state-specific rules that we need to operate around? Then there's Social Security taxation, which varies widely. At the federal level, Social Security may be partially taxable. At the state level, it depends. Many states do not tax Social Security at all. Some do. Others provide partial exemptions based on income thresholds. This creates meaningful differences. A retiree with $60,000 in Social Security and a modest IRA withdrawals may owe nothing in one state and thousands annually in another. And because Social Security often forms the income floor of retirement, the way it's treated at your state level matters year after year. In many of the states that do tax Social Security apply exemptions or deductions for overall income levels and age just to complicate matters even more. And then there's the fact that IRA and pension taxation isn't consistent. Traditional IRA withdrawals and pensions are treated differently depending on where you live. Some states fully tax retirement income, offer partial exemptions, exempt certain pension types, or exclude a fixed dollar amount annually. For example, one state might exempt the first $20,000 of retirement income, another may exempt government pensions but not private pensions, and another may exempt all qualified retirement income altogether. These nuances create very different long-term outcomes, especially for retirees with large pre-tax balances or large annual income streams via pensions and annuities. Then there's the capital gain side of things. We've been talking about ordinary income sources this whole time. Capital gains are a completely different animal. Many retirees assume capital gains are taxed uniformly, and they're not. Some states tax capital gains as ordinary income. If you live in California, Minnesota, or Pennsylvania, among others, this applies to you. Some states provide preferential rates by either excluding a portion of your income or putting a hard cap on the percentage they apply. Some states offer exclusions for long-term holdings, and others provide zero tax on gains. And then there's a unique case in Washington state where they don't tax personal income, but they tax capital gains at a 7% rate above a certain threshold. So if you plan to live off taxable brokerage account, the state you choose can materially affect how much of those gains you get to keep. For retirees who've accumulated significant taxable wealth, this variable alone can justify relocation, but only after modeling the trade-offs. Then there are property taxes, which is the silent retirement tax. Income taxes get all the headlines. Property taxes, though, they quietly erode income. Some states with no income tax have high property tax rates, no homestead protections, and limited caps on increases. Others offer property tax freezes for retirees, homestead exemptions, and circuit breaker credits for low-income retirees. If you plan to remain in a high-value home, property tax differences can rival income tax savings. For many retirees, this becomes the largest fixed expense in retirement. And don't forget about estate and inheritance taxes. Even if you're below federal estate tax thresholds, some states impose their own estate or inheritance taxes. That means your heirs could owe taxes at the state level even if no federal estate tax applies. These rules vary widely and are often overlooked in relocation decisions. If legacy planning matters to you, this layer must be included in the analysis. Now we want to talk about the domicile trap. Changing states isn't as simple as buying a second home. States care about residency, especially high tax states. If you claim residence in a no income tax state but still maintain strong ties to a high tax state, you may face audits or dual tax claims. True domicile requires primary residence changes, driver's license updates, voter registration changes, and time spent in state documentation. For executives and retirees leaving high tax states, this step must be handled very carefully. And this also leads to why relocation isn't always the right answer. While tax savings can be compelling, relocation decisions shouldn't be tax-only decisions. You want to consider access to healthcare, proximity to family, lifestyle preferences, climate risk, insurance costs, and community. The best retirement state isn't necessarily the lowest tax state. It's the one that balances lifestyle and financial efficiency. Taxes are a big factor. They're not the whole equation. Before we go over a practical example, I wanted to thank you all for watching our video today. State-based retirement planning is a huge component of a successful plan. As you'll see in our example, it can literally be hundreds of thousands of dollars of difference over the course of retirement. So if you find this video helpful when thinking through your state's tax burden on what you've accumulated, please throw this video a like and subscribe to the channel. We drop content like this weekly and want to make sure you don't miss any of it. Now let's jump to the practical example. Consider 3 retirees. One lives in Pennsylvania, another in California, and the final one in Minnesota. And for simplicity, let's say that each of these retirees has the same exact income structure. They're married and have $60,000 a year in Social Security benefits, realize $50,000 of capital gains, and distribute $150,000 from their retirement accounts. In this example, they all have the same federal tax liability, roughly $7,500 for capital gains and $25,000 in federal income tax from ordinary income. Let's look at how state income tax burden varies by state now. Starting with the couple in Pennsylvania, this couple pays nothing on the IRA withdrawal or Social Security. They do pay a 3.07% tax on capital gains, and that's roughly $1,500. The California couple pays taxes on the IRA distribution and capital gains, but they don't have to pay it on Social Security. The overall tax burden for this couple is about $13,000 or nearly $12,000 more than our Pennsylvania couple. Finally, let's go over our Minnesota couple now. They are subject to taxes on IRA distributions and capital gains, are taxed as ordinary income, and Social Security is generally included in state taxable income, but Minnesota does offer an income-based subtraction. For this couple, unfortunately, though, they're above that threshold. They would owe roughly $17,000 in taxes to the state of Minnesota. Let's throw a few more wrinkles into the plan now. Let's say that they all own a home worth $1 million. The average property tax rate in Pennsylvania is roughly 1.4%, so annual property taxes would be around $14,000 for this couple. In Minnesota, it's slightly lower at 1.1%, which equals $11,000 annually. And California is the lowest, which is around 0.7% or $7,000 on $1 million home. So that means between property and income tax, the Pennsylvania couple has roughly $15,500 in state tax overhead. Minnesota has $28,000 in state tax overhead, and California comes in at about $20,000. Finally, let's add one more variable to the problem now. State sales tax. Let's assume that each of these couples spends $100,000 annually on purchases that would face a sales tax. In California, they pay 8.83% sales tax, Minnesota's 8.13%, and Pennsylvania pays 6.34%. This means that the total tax bill for a couple who spends $100,000 annually, earns $60,000 from Social Security, pulls $150,000 from their IRAs and realizes $50,000 capital gains, would pay a total tax between property sales and income taxes of about $22,000 in Pennsylvania. Minnesota would pay roughly $36,000, and California would pay about $29,000. This is important because over a 20-year retirement, PA residents at this level will pay $140,000 less in state-based income taxes than those in California, and nearly $280,000 less than those in Minnesota. And California residents would pay $140,000 less than the Minnesota residents themselves. Based on withdrawal rates, that's an extra year of retirement income for couples in Pennsylvania versus those in Minnesota, just because they live somewhere completely different. So when does state tax planning matter most? Well, state tax differences matter most when you have large pre-tax retirement balances, you plan to draw significant taxable income, you have flexibility to relocate, you are retiring from a high tax state, you are planning significant Roth conversions, and you own property. If you have modest taxable income and low retirement withdrawals, the impact may be smaller. State tax planning is most powerful when income is meaningful. The bigger takeaway is that retirement isn't just about asset allocation. It's about geography and tax burden. Federal tax planning is complex. State tax planning adds another dimension. Where you live affects income taxation, Social Security treatment, capital gains, property taxes, and estate exposure. Two retirees with identical net worth can experience radically different retirement outcomes simply because of where they choose to live. The bottom line here is that the retirement tax map is not uniform. State-by-state differences create meaningful, compounding effects over decades. Tax-friendly headlines don't tell the full story, and relocation decisions should be modeled, not assumed. Before you move for tax reasons, understand the full picture: income, property, estate, healthcare, and lifestyle trade-offs. If you want help modeling how your state affects your long-term retirement outcome, and whether relocating makes financial sense, that's exactly what we do here at NavWealth Partners. Thank you so much for watching, and as always, make smart money decisions.